EPK Capital presents Deep Dive on Cholamandalam Invest. All right, let's talk about a stock that's been on an absolute tear. It's in the business of lending money to truck drivers, to home buyers, to small businesses. It's a company that has turned 1 lakh rupees invested 5 years ago into, well, a lot more than 1 lakh rupees. Hello, and welcome to EPK Capital's Daily Market Briefing. I am your host, AI Rutvik, and today we are going to talk about Cholamandalam Invest. Is this high-octane growth engine just getting warmed up, or is it about to overheat? Today, we are putting Cholamandalam Investment and Finance, or Chola Invest, under the microscope. We're going to dig into its 10-year report card, check the chart, run it through a value investing X-ray, and see if the bull case holds up against the bear case. And yes, there will be numbers. Lots of glorious numbers. Let's get into it. The company and its promoters. So, who is Cholamandalam Invest? If you've ever wondered who finances the massive trucks you see on the highway or the small corner Kirana store expanding its shop, there's a good chance it's these folks. Chola is a non-banking financial company, or NBFC. In simple terms, they are like a bank, but not a bank. They borrow money, and then they lend that money out at a higher rate. Their bread and butter is vehicle finance. We're talking trucks, tractors, and cars. But they've also expanded aggressively into home loans and loans against property. And they aren't some small startup. As of October 2025, we're talking about a massive 1.43 lakh crore rupees, or $17.2 billion, market cap company. But here's the key. They aren't alone. Chola is the financial services arm of the Murugappa Group. If you don't know that name, you should. The Murugappa Group is one of India's oldest and most respected conglomerates. We're talking about a business empire that started in Burma over a century ago and now has its fingers in everything from engineering and fertilizers to sugar. Having a promoter like the Murugappa Group is like having a very rich, very smart, and very well-connected parent. It provides stability, credibility, and deep pockets. The 10-year financial analysis. Okay, time for the report card. How has Chola actually performed? Over the last 10 years, Chola has grown its sales at a median rate of 18.4% per year. That is incredibly consistent and very, very fast. This is where it gets wild. Over the last 5 years, their profit has compounded at an eye-watering 32.2% per year. Yes, you heard that right. Let's talk margins. In the lending business, you live and die by your net interest margin, or NIM. This is the simple difference between the interest you earn on loans and the interest you pay on borrowings. In March 2023, their NIM was 5.1%. By March 2024, it was up to 6.6%. And as of June 2025, it's sitting at a very healthy 7.8%. That's a fantastic trend. They're making more money on every rupee they lend. This is my favorite. It shows how well the company uses shareholder money to make more money. Chola's ROE is a rock-solid 19.7%. Anything over 15% is great. Nearly 20% is fantastic. So, the report card is, well, it's a straight A, student. Blistering growth in sales, even faster growth in profits, and widening margins. To lend money, you must borrow money. Chola's debt-to-equity ratio, or gearing, is around 7.4. Now, before you panic, that's high, but it's not insane for an NBFC. It's part of the business model, but it is a number you have to watch. High leverage is like driving a sports car at 200 miles per hour. It's thrilling, and you're getting there fast. But if anything goes wrong, it goes wrong spectacularly. Stock chart technical analysis. Now, what is the stock chart telling us? Does the market agree with this rosy picture? As of late October 2025, the stock is trading around 1,700 rupees. Its 52-week low was 1,168 rupees, and the high was 1,782 rupees. So, we are definitely near the top of that range. The chart is in what technicians would call a beautiful, textbook uptrend. It's been making higher highs and higher lows. We recently had a double bottom formation, and the price broke out decisively above a key resistance level around 1,530 rupees. It's been on a one-way trip since. Right now, the chart shows strong support around the 1,650 rupee level. But here's the interesting part. The RSI, or relative strength index, which measures momentum, is flashing mixed signals. One technical report I read noted a negative divergence, which is a fancy way of saying the price is hitting new highs, but the momentum behind it is getting a bit tired. This can sometimes be a warning sign for a short-term pullback. On the other hand, other analysts are screaming strong positive momentum and have price targets way up at 1,880 rupees and even 1,935 rupees. So the chart is bullish, but it might be a little out of breath right now. Benjamin Graham valuation. Okay, so it's a great company, but is it a great investment at this price? Let's ask the father of value investing, Benjamin Graham. Graham had a formula to find the intrinsic value of a stock. Let's plug those in and we get an intrinsic value of 2,430 rupees per share. Wow, okay. So, with a current price of 1,700 rupees, the Benjamin Graham formula, which is famously conservative, says the stock is significantly undervalued. Now, a huge grain of salt here. This formula loves high-growth companies, and that 30% growth rate is the magic ingredient. If you think 30% growth is unsustainable, and you plug in, say, 15%, the value drops dramatically. But based on its 5-year track record, the numbers are what they are. Pros versus cons, the bull versus bear case. Let's boil this all down. Why would you be bullish and why would you be bearish? A 32.2% 5-year profit CAGR. You just can't argue with those numbers. Backed by a top-tier promoter group. This means stability, good governance, and access to cheap capital. The stock is in a clear uptrend, breaking out of patterns, and analysts are lining up with buy ratings. The 7.4 debt-to-equity ratio is a big number. If India's economy slows down or interest rates spike, this leverage could bite back hard. One report noted a low interest coverage ratio, which means its profits don't cover its interest payments by as much as we'd like to see. It's a direct consequence of that high debt. A price-to-earnings P/E ratio of 32 isn't cheap. It's cheaper than some rivals, but it's pricing in a lot of future growth. If that growth slows, the stock will get re-rated. That negative RSI divergence is a small red flag. It suggests the easy money might have been made for the short term. Conclusion? So what's the final verdict on Cholamandalam Investment? We have a financial powerhouse, a best-in-class NBFC with a stellar 10-year report card, explosive profit growth, and the backing of a blue-chip promoter. The technicals are strong, and even a classic valuation model suggests there could be more upside. On the flip side, it's a company built on a mountain of debt. That leverage is what fuels the growth, but it's also its greatest risk. It's trading at a premium valuation that demands this high growth continues, and there are some worrying signs about its collection practices and a tired-looking momentum indicator. Is it a rocket ship just refueling, or is it flying too close to the sun? Well, that's for you to decide. Thanks for watching. If you learned something, hit that like button and subscribe for more deep dives. See you next time. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice.